While most people were arguing about where the market would go next, something else was already decided. Screens flickered with green and red, comment sections filled with predictions, confidence, certainty. It felt active. It felt intelligent. It felt under control. But real decisions don't wait for consensus. Away from the noise, away from the timelines, a process reached its final step. No announcement, no dramatic headline, just documents completed, procedures finalized, and a date locked in place. That date is Monday. Not later this year. Not after a warning. Monday morning, when markets open, the framework shifts. They didn't debate it, they finalized it. There is a place most people will never see. No cameras, no live streams, no trending clips. It doesn't care what's popular, and it doesn't respond to public outrage. This is where the rules of money are adjusted quietly, long before the consequences reach everyday life. The most important financial decisions on earth don't happen in parliaments or on cable news. They happen in restricted rooms, controlled by institutions that are never on ballots and rarely mentioned by name. Institutions that don't need public approval because their authority comes from the system itself. At the center of that system sits the Bank for International Settlements. Often called the central bank of central banks, it operates above nations, above politics, above headlines. When guidance comes from here, it doesn't debate. It cascades. This is where money rules are rewritten. This isn't a rumor that leaked early or a theory circulating on forums. It isn't a proposal waiting for approval or a draft open for discussion. The decision is finished. The language is finalized. The compliance clock has already started ticking. This rule completed its final phase quietly, the way the most important rules always do. No vote from the public, no warning label for the average saver, just a switch waiting to be flipped when markets open. There's no appeal process here, no delay button, no renegotiation once it begins. You don't vote on rules like this, you live with them. The rule itself has a boring name, so boring that most people would scroll past it without a second thought. But boring names are often camouflage. They keep attention away while foundations are being altered underneath. This isn't about markets in the way people usually think about markets. This is about plumbing, the pipes behind the walls, the systems that decide what is solid and what is fragile. You can repaint a building and nothing changes. But when you change the foundation, everything above it has to adjust. That's what this rule does. Known formally as Basel III, it doesn't tell banks what to buy or sell. It changes what counts as safe, what counts as risky, and how much it costs to pretend the difference doesn't matter. Plumbing failures collapse buildings. For decades, the system ran on a quiet assumption that a promise was just as good as the thing itself. That a piece of paper claiming ownership could stand in for real metal sitting in a vault somewhere, owned by someone else, or maybe by no one at all. Think of it like this. Imagine the same house being sold to 10 different people. Everyone has paperwork. Everyone thinks they're protected, but only one person can actually open the front door. That's how paper, gold, and silver worked. Multiple claims layered on top of the same physical asset, multiplied over and over again. This wasn't a short-term trick. It lasted for generations. It became normal. It became trusted. And because it worked most of the time, no one questioned what would happen if everyone showed up at once. What if your money wasn't really there? Banks didn't build this system because they were evil. They built it because it was efficient. Paper markets allowed them to move massive amounts of value with very little capital tied up. Leverage made returns bigger. Short positions made price control cheaper. And low capital requirements made all of it look safe on paper. As long as confidence held, the system rewarded everyone inside it. Profits grew. Balance sheets expanded. Risk was mathematically minimized, or at least it looked that way. The structure encouraged repetition, not restraint. And for a long time, it worked. Smoothly, quietly. The game worked until it didn't. The new rule doesn't accuse banks of wrongdoing. It does something far more powerful. It changes the cost of behavior. Overnight, assets that were once cheap to hold suddenly become expensive. Positions that looked harmless on a balance sheet now demand real backing. At the center of this shift is a simple idea. If something is risky, it should be funded like it's risky. The net stable funding ratio does exactly that. It asks banks a blunt question. Do you have stable, long-term resources behind the promises you've made? If the answer is no, the penalty kicks in. Paper assets, especially unallocated metal, now carry weight. Not physical weight, financial weight. They strain balance sheets. They tie up capital. They force choices. When rules change, behavior follows. Once the math changed, the first pressure point became obvious. Short positions that were once cheap to maintain suddenly weren't. What used to require a small margin now demanded serious capital. And capital, under the new rules, is no longer something banks can waste. This isn't about fear or market sentiment, it's about compliance. A short position that ties up too much balance sheet space becomes a liability, not a strategy. So, banks do what banks always do when incentives flip. They unwind, quietly, methodically, often before anyone notices. This is why movements start without headlines. Not because someone panicked, but because spreadsheets stopped agreeing. This isn't panic, it's paperwork. When prices rise this way, it confuses people. There's no viral narrative, no sudden excitement on social media, no army of new buyers chanting slogans. And yet, the market moves anyway. That's because this kind of demand doesn't come from belief, it comes from obligation. Banks aren't buying because they feel bullish. They're buying because the rules leave them no alternative. When you must act to stay compliant, timing becomes secondary. Speculation asks permission from confidence. Forced demand doesn't. It arrives on schedule, regardless of mood, regardless of opinion. And when enough large players are pushed in the same direction at the same time, price becomes a side effect, not the goal. Compliance doesn't ask permission. You may have already seen the first hints, without realizing what they were. Strange pauses, thin liquidity, sudden gaps where orders used to be, moments when the market felt hesitant, as if it was holding its breath. These weren't technical glitches, and they weren't accidents, they were preparation. When insiders know a rule change is coming, they don't charge forward. They step back. Market makers pull orders. Algorithms are adjusted. Exposure is reduced. No one wants to be caught standing on the wrong side of a rule when the clock runs out. To the public, it looks like nothing, or noise, or coincidence. But silence, in markets, is rarely empty. It's often intentional. Silence is often the loudest signal. For a long time, gold sat in an awkward category, treated like a risky asset, lumped in with things that fluctuate, things that can fail, things that need to be discounted just in case. On paper, it was handled more like a stock than money. That changed. Under the new framework, gold is no longer viewed as something that needs to be hedged against. It's treated as something that does the hedging, a stabilizer, a backstop. In simple terms, it moved up the safety ladder, from questionable to dependable. For banks, this isn't just an accounting tweak. It's psychological. Assets once tolerated are being replaced by assets that are trusted. When an institution built on risk management decides something is risk-free, it sends a message far beyond the balance sheet. Money just remembered what it trusts. We've been here before, even if it doesn't feel like it. History rarely repeats itself in obvious ways. It doesn't use the same headlines or the same language. But it follows the same patterns, especially when it comes to money. In 1971, the world was told a technical adjustment was being made, a temporary measure, a quiet decision that most people didn't understand at the time. When Richard Nixon closed the gold window, there were no riots in the streets, no countdown clocks, just a rule change that rewired the global financial system overnight. Currencies drifted, prices adjusted, wealth moved. Not immediately, but inevitably. That's what makes moments like this dangerous and powerful at the same time. Rules don't repeat. They don't need to. The consequences do. When banks begin buying hard assets, something else has to happen at the same time. They don't create new value out of thin air to pay for them. They exchange, and what they exchange is currency. This isn't about politics or confidence or narratives. It's basic arithmetic. If dollars are sold to acquire metal, the supply of dollars increases relative to what backs them. More units chasing the same foundation. The pressure doesn't show up all at once, but it builds. Currencies don't collapse dramatically at first. They erode, quietly, gradually. Purchasing power thins out at the edges. Everyday costs rise before people understand why. It feels disconnected, even though it isn't. When real assets are pulled upward by demand, paper claims absorb the strain. Something has to give. As balance sheets tighten, lending feels the pressure next. When banks are required to hold more capital against what they already own, they have less flexibility to extend new credit. Not because they don't want to, but because the math no longer allows it. This doesn't stay trapped in financial theory. It shows up in daily life. Mortgages become harder to qualify for. Business loans take longer to approve, or never do. Expansion plans pause. Hiring slows. The system quietly shifts from abundance to caution. Credit is the bloodstream of the economy. When it slows, everything downstream feels heavier, more expensive, more fragile. Most people won't connect it to a rule passed months earlier in a distant room. They'll just feel that something changed. Tighter money feels personal. This is where pressure comes from both directions at once. Growth slows because credit tightens, but prices don't fall the way they're supposed to. Essentials still cost more. Energy stays expensive. Food doesn't get cheaper just because lending dries up. That combination has a name history remembers well: stagflation. It's the environment policymakers fear most because there's no clean lever to pull. Raise rates and you crush growth. Cut rates and prices run even hotter. Every move solves one problem by making another worse. In these conditions, assets tied directly to production and scarcity behave differently. They don't depend on optimism. They don't need growth. They respond to imbalance. When money loses stability and the economy loses momentum, hard assets stop acting like trades and start acting like shelters. This is the trap policymakers fear most. While much of the West was still arguing about models and assumptions, others made their adjustments quietly. Different system, different priorities, less faith in paper promises, more emphasis on what could actually be delivered. In parts of the East, markets were built around physical settlement, not layers of claims. Assets were counted only if they existed. Risk was treated as something to avoid, not something to engineer around. When the rules began shifting, these systems didn't need to scramble. They were already aligned. This wasn't ideology. It was adaptation, preparation, instead of reaction. While some were debating, others were positioning patiently, methodically, without noise. Some prepared quietly. Zoom out far enough, and the pattern becomes impossible to ignore. The names change, the instruments evolve, the language gets more sophisticated, but the sequence stays the same. A rule shifts. An asset is reclassified. Prices adjust. And wealth moves not randomly, but predictably. This is how transfers happen in modern systems. Not through sudden collapse, but through technical adjustments that only a few understand while they're happening. Those closest to the rules move first. Everyone else reacts later, after prices have already adapted to the new reality. We've seen it before. In 1933, gold wasn't confiscated because it was useless. It was confiscated because it was about to be revalued. Paper holders were paid out. Physical holders preserved purchasing power. The mechanism was different, but the outcome was the same. This has happened before. When systems shift at this level, the effects don't stay abstract for long. Eventually, they land in individual lives, not as breaking news, but as subtle pressure. Options narrow, assumptions stop working. What once felt stable starts to feel conditional. This isn't about copying institutions or reacting out of fear. It's about understanding incentives. Large players don't move on emotion. They move on rules. And when those rules change, alignment matters more than timing. Being early is less important than not being positioned against the current. People who focus only on headlines tend to act last. People who watch incentives act differently. They ask what is being rewarded now and what is quietly being penalized. In periods like this, survival favors clarity over confidence. Follow incentives, not headlines. All of this circles back to timing, not as a prediction, but as a line, a before and an after. Markets don't wait for understanding. They move ahead of explanations, pricing in realities long before they're widely discussed. Monday isn't about a sudden spike or a single dramatic candle. It's about a psychological shift, a moment when institutions begin operating under a new set of constraints. From that point on, behavior adjusts quietly, systematically, and without apology. People will look back later and mark charts, trying to identify when things changed. But the change won't be visible in hindsight the way they expect. It will already be embedded in prices, policies, and access. After this, there is no before. There's a temptation, in moments like this, to look for urgency where none is needed, to turn inevitability into panic. But this isn't about rushing. It's about recognizing direction. Systems this large don't turn on emotion. They turn because the rules force them to. What matters now isn't reacting to noise, but observing behavior. Watching what institutions are accumulating, not what they're talking about. Paying attention to what becomes scarce, not what gets promoted. The biggest signals rarely come with alarms. They come wrapped in boredom, buried in regulation, disguised as maintenance. The rules changed because the old structure could no longer hold. That alone tells you what the system values going forward. The question isn't what will happen, it's whether you notice it while it's happening. The rules changed. Did you?